Okay, for chapter 1, one of the problems that you have to do is to work out a contribution margin income statement and compare it to the traditional income statement that you learned in financial accounting. So we're going to go through this exercise looking at both, where you can see that you still get the same answer. It's just you get there in a different way. Okay, so this company is a merchandiser, and they have the following information. They sold 12,000 units, and the selling price per unit is $25. So if you want to figure out how much they earned in sales, you would take the $12,000 and multiply it by the 12,000 units and multiply it by the $25. Now in managerial accounting, we are going to separate everything by variable cost and fixed cost. We will also look at selling expenses and administrative expenses separately. With variable expenses, it is shown as a per unit amount. For variable selling, it's $2.50 for every unit they sell. Variable administrative expense is $2 per unit that they sell. Then we have our fixed expenses, which isn't per unit, it is in totality. So with variable expenses, they're going to increase as sales increase, and they're going to decrease as sales decrease. But when looking at fixed expenses stay the same regardless of how many units were made or sold. Some other information that you need to know is what you started the period off with, what your beginning balance was on inventory, and then what your ending balance is in inventory. You also need to know what you purchased throughout the period. Okay, one of the first things we're going to calculate is cost of goods sold. And cost of goods sold, which you should have learned from financial accounting, is beginning inventory plus purchases minus ending inventory. We will need to calculate that in our income statement. So we would take the $25,000 of beginning inventory, add the $101,000 that we purchased throughout the period. That will give us the total available. Then we will subtract what we have left at the end of the period, and that will give us our cost of goods sold. That will give us the amount that we sold. Okay, we're going to first do the traditional income statement, the one that you are more familiar with. And it's basically sales minus expenses. So again, the sales, they sold 12,000 units at $25 per unit. That will be $300,000. Now, this is the formula that I just talked about to get cost of goods sold, where you take beginning inventory of $25,000, you add what you purchased, which is $101,000, and then you subtract what you have in ending inventory at the end of the period. That was $18,000. So cost of goods sold was a total of $108,000. If you subtract your sales from your cost of goods sold, you are going to get your gross margin. Your gross margin is the amount left over from your sales after paying for the items that you sold. After calculating your gross margin, we're going to look at selling and administrative expenses. And with the traditional income statement, we are not going to separate out the fixed from the variable. They're going to be combined together. Your total selling expenses will have an amount, and then your total administrative expenses will have an amount. So how you derive at the answer for selling expenses is you're going to take your $2.50 per unit, multiply it by how many units you sell, and that will give you your variable selling expense amount. Then add your fixed expense of $16,000. For your administrative expenses, take that $2 variable expense per unit, multiply by the $12,000 that you sold, and then add that to your fixed administrative expenses. And you get $41,000. Then you will take your, actually, it's missing a number. Okay. So it's missing a number. There should be a number right here that is 46,000. Your selling expenses are a total of $46,000. Your administrative expenses are a total of $41,000 to give you your total of $87,000 for your selling and administrative expenses. Then you take your gross margin of $192,000, subtract your total selling and administrative expenses, and you get your net operating income of $105,000. Okay, so I just wanted to clarify a couple of things before we move on to the contribution margin income statement. The selling expenses we know are a total of $46,000. And when you take $2.50 per unit by the 12,000 units sold, you get $30,000. Then take that $30,000 plus the $16,000 to give you the $46,000. Now the same thing with administrative expenses. Administrative expenses are $2 per unit times the 12,000 units sold. That of course is $24,000. Plus the $17,000 gives you the $41,000. Then add the $46,000 and the $41,000 together to give you $87,000. Take your gross margin, subtract your total expenses, gives you $105,000 net operating income. Now, when we do the contribution margin format income statement, you're going to get $105,000 again. It's the same thing, but we're just divvying it up differently. Okay, let's take a look at the next one. Okay, here's the contribution format. We start with sales. That's going to be the same thing. But when you do the traditional income statement, you subtract your cost of goods sold to give you your gross margin. Here, we're going to subtract our variable expenses from sales. Our variable expenses are our cost of goods sold. That stays the same. But then we also have to subtract our variable selling and administrative expenses. Our variable portion of our selling expenses was the $30,000, $250 times $12,000. And then our administrative expenses will be the $2 times the $12,000, which was $24,000. Our total variable expenses is $162,000. We're going to go ahead and subtract that from our sales, and then we get $138,000. With the contribution format, instead of finding the gross margin, we're finding the contribution margin. The contribution margin is sales minus all variable expenses. Now from here, we're going to subtract our fixed expenses, and we have two. selling expenses of $16,000 and administrative expenses of $17,000. That's a total of $33,000 of fixed expenses. Subtract that from your contribution margin and you get net operating income of $105,000, which is exactly the same as when we do the traditional income statement. So everything that you put on a traditional format is the same thing you put on a contribution format. The only difference is we're going to take the variable and the fixed expenses and separate them out. Instead of putting them together to get a total selling and then a total administrative, we're going to take the variable and subtract it from sales to get our contribution margin. Then we'll subtract our fixed expenses after. Still using the same numbers, still getting the same answer. It's just divided differently. And the reason why in managerial accounting you do that is because most of managerial accounting is internal. And internally, the managers, especially in merchandising and manufacturing companies, are going to want to see what the variable and fixed expenses are separately. Because we're going to start making decisions and recommendations to companies as to what they should do. If we want to look at dropping a product line, some of the fixed expenses are still going to be there even after we drop that product line, but the variable expenses will go away. So we want to separate the two out so we can make better and more informed decisions for the companies.